It's already been a huge year for M&A, and 2016 could be even bigger. Hello and welcome to this special edition of the Deal Report. I'm Jeff Kanige. My guest today can help us see into the future. Richard Jeanneret is America's Vice Chair for Transaction Advisory Services at EY, and the firm is out with the latest edition of its Capital Confidence Barometer, which has some interesting indications about what may lie ahead. Rich, welcome.
It's great to be back.
So can you give us a little brief outline of what the CCB is and how you go about compiling it?
Sure. The Capital Confidence Barometer, this is our 13th edition. We release it twice a year. It's a survey of roughly 1,600 C-suite execs around the globe, close to 40% here in the United States. And it's generally the CEO, CFO, head of M&A, those folks who are making business decisions for the company. It's all about their view on and outlook on capital flows, the state of the economy, what their appetite for investing is over the next 12 months, and generally how they feel about the rest of the world from an economic perspective, and we also ask them about unique trends in the M&A business, their particular concerns about risks and rewards. So it gives us a pretty good barometer of what's happening in the economy.
Right, and what was interesting to me is, as I mentioned at the top, it was a big year this year. Despite volatility in the commodities markets, the equities markets, some continued slow growth. And yet this year, more executives are interested in doing deals next year than this time last year, 59% as opposed to 40%. What do you think accounts for that kind of increased appetite in face of everything that we've seen?
So the story clearly has been the year of the big deal, and it's been a successful year in M&A. Generally, acquired stock gets traded up, so they're getting rewarded for deal making. That's a new phenomena in this M&A cycle as compared to the prior cycles where stocks tend to get traded down because of concerns about dilution. Top line growth getting harder to drive today, Jeff, simply because the global economy is slowing down. So strategic M&A, a technique for the C-suite to drive shareholder value, create top line growth. And I think what the real story for this year is it's the year of the big deal. More investors and corporations willing to take greater risk in their deal making. I think that bodes well for continued deal making in the future. The CCB had a real upsurge in the level of confidence around deal making. 75% of the U.S. respondents say they're going to do deals in the next 12 months, bigger pipelines than ever before. And most interesting, more than half of those surveys said they would, that those doing deals said they would, 90% of them said they would do deals outside of their industries. A lot of convergence occurring with various sectors right now.
Okay, so what are they looking for? I mean, in the past it has been all about growth, as you mentioned. Are
Sure.
they looking for different kinds of things this time around?
You know, they're clearly continuing to look for growth, particularly because the market likes the strategy. And so, as I said, it's trading stocks up. But the other thing they're looking at is the change in business model that's occurring all throughout corporate America, really around the world today, and the disruption that's occurring in American and global businesses. They're using M&A to transact change in their business model. So they're looking at disruption, they're looking at transformation, and they're saying, you know, maybe the best ideas for my business might be in another industry. Let's acquire technology, let's acquire intellectual capital, potentially good workforce and goodwill, and so the best ways to do things may no longer be in my industry. Let's go elsewhere and see if someone else knows how to do it better.
Okay, and are there particular sectors that or regions of the world that you're seeing most activity in?
Well, you know, with respect to business model disruption, one that's quite interesting is the consumer product space. You know, the millennials, the way the world is digitizing, the Internet of Things is transforming and disrupting business models all day long. So changing consumer preferences, changes in technology. The old line consumer product companies have to go look at technology and other ways to do things to get things done. We're clearly seeing big industries continue to transact for growth and shareholder value. Life sciences, the whole pharmaceutical industry, there's no shortage of news there all year long. A lot still to come in healthcare. There's been a lot of advance in digital technology in the healthcare space, but at the end of the day, there's still a lot of costs to come out of that business. So I think you'll see transaction for consolidation. You know, healthcare companies transacting around the consumer for better consumer patient outcomes, looking at the patient more like a consumer than ever before.
Right, sure. Now, one of the things we've, in our reporting, a phenomenon that we've observed is a difference, shall we say, in expectations between buyers and sellers. Are you seeing the same kind of valuation gap, and if so, is that likely to continue?
So we saw a little bit of the narrowing in the last 12 months of the valuation gap in actual transactions that had gotten done. The stock market came in for a while this year. It's almost back to where it started. So that's making valuations a little bit tougher. And we saw a surge in the surveys respondents' results, which we generally did in August and September when the market started to recover some, that the valuation gap is starting to widen out a little bit again. But the cost of capital is so low today, Jeff, and there's so much of it that valuation multiples can rise, but with cheaper capital, you can still make the returns work for the shareholder.
Right. So are there any risks, are there any challenges that you can see that could change the outlook?
Yeah, I think the geopolitical environment is still the one that spooks investors and undermines confidence the most. Clearly getting a budget and debt deal done in Washington last week I think is a good sign to remove some of that. But uncertainty around the rest of the world because of currency, because of slowing economies, some security, instability in certain parts of the world, that clearly weighs on the mind of investors, and I think that's the biggest single obstacle. The U.S. economy is still looking relatively strong, certainly compared to the rest of the world. So that's not undermining confidence the way perhaps it did several years ago. I think it's geopolitical, but we ticked one off with Washington last week, and then we've got probably 2 years out of that deal. So I think deal making is going to pick up in 2016. Tough prediction after 2 straight years of good deal making, but there's a lot of capital available. Markets like the strategy of M&A for growth and shareholder value creation, so I think it's going to run for a while.
Okay, and that seems to be borne out by what you were seeing in this recent report.
You bet.
Okay, Rich Jeanneret, thank you very much for joining us, and thank you for watching. In New York, I'm Jeff Kanige for The Deal.